Good morning, good morning. Welcome everyone. Welcome to today's webinar, Sustainable Investing. Thank you so much for joining us. We're so grateful you could take time out of your busy day for this program. We're so pleased to be hosting the session today along with Nuveen. As you can imagine, this type of investing is becoming more and more important to people, and we're pleased to be able to dive into the option of promoting positive change through investing. A little bit about today's speakers. Paul King, CEO of KingWealthPlanning and LPL registered principal, you all know Paul, and Margaret Lee Young, head of ETF distribution at Nuveen, and you'll meet her shortly. Before I hand the mic over to Paul and Margaret, I have a few housekeeping items to cover. First, today's session is being recorded and will be available and accessible through the KingWealthPlanning website, kingwealth.com. We've also added some attachments, which are available through the attachments area in the toolbar located to the right of your screen. Next, we'd love to hear from you during today's presentation. Due to compliance regulations, the chat feature is disabled. If you have a question for our speakers, please feel free to send it through email to me at shannon@kingwealth.com. We will address questions at the end of the session. So without any further ado, I'd like to kick things off by welcoming our speakers. Paul and Margaret, welcome, and over to you.
Thank you, Shannon. Good morning, Margaret.
Morning.
So this is a topic that's really close to me, having started in this business over 30 years ago. I was still an engineer, actually, at Hewlett-Packard, and doing this part-time, but also doing some work for Sierra Club. And back then we called it socially responsible investing, but there was a few funds out there that had these kind of specialties, but over the last 5 years has seen a growth like nothing else in the business. So we'd like to introduce that topic today and have Margaret, who's with Nuveen. Nuveen's been a great partner for us, a lot in the municipal bond space, but Nuveen's a major fund company in a lot of other areas as well. And so we just want to have a conversation about what the sustainable investing, or I term it responsible investing, and we'll go into kind of where all that terminology is. But talk about how we're applying it here for our clients. So Margaret, I'll let you kind of kick it off and kind of give an overview of what are we talking about.
Absolutely. And for our slides, are you driving today? I thought you were driving. Am I driving?
I am. I got you.
Wonderful. Okay. Just last minute. Did we go over that? Wonderful. Yep. Well, yes, today we're going to talk about responsible investing, where it's come from over the past few years, and not just few years, but several decades, and why it's so important to consider and to even integrate now, especially in the year 2020. So there's a lot of myths out there about what this type of investing means. I want to dispel that and just bring to light some of the rationale behind looking at risk in a different way, what it's called, all the different definitions, terminologies, and the benefits of integrating responsible investing into one's portfolio.
You had a couple examples here of why people might be interested.
Sure. And you know what's interesting is that I'm not seeing the slides, and so that was, I guess, the reason for my question. But I'm so familiar, if you want to just tell me which slide we're on, then I can follow along.
Should be on. So hold on just 1 second.
don't have the slide.
Margaret, do you have the slides there if I make you a presenter? That you can run.
Yeah, I can do that. Sure.
I don't know why they're not showing. Let's try that.
Show my screen. Is it, one moment. I'm going to make sure the proper thing is up. Okay.
Oh, you know what it is? I got it here. You see them now?
Wonderful. Yes, I do. Okay. Wonderful. Let me get that meeting screen back up. Okay. So perfect. Thank you everyone for your patience here. This looks familiar. Now, so we're talking about responsible investing and where we've come from, and are we responsible investors? And so sometimes we don't necessarily label ourselves as a responsible investor, but 2020 has given us a lot of time at home. Has anyone started volunteering this year, whether it's virtually? I know we just came through a large election. I received a lot of phone calls from volunteers encouraging me to vote, whether it was for a specific candidate or just to exercise my right to vote. So there's a lot of ways that we can volunteer our time towards causes that we care about. So this is one way that we can think about what are our values, what are we spending our time doing. Another is the hashtag, which you can see on the bottom of our screen here. Have you engaged on social media in a hashtag campaign? What does that mean? Have you ever posted something that said a comment or a picture and then hashtag something? Hashtag Black Lives Matter, hashtag Me Too, hashtag Delete Uber, hashtag 2020. I don't know. We've got a lot of campaigns that are going on out there, and whether or not you've actually gone through and created that hashtag for yourself, if you've liked something with a hashtag or shared or commented on something, you are engaging in this platform that we now have to make our voices be heard that didn't exist in the force and the strength that it does today that it did 5 years ago. So we've got some changes there as well. So these are all voluntary things that we're engaging with. And then on the upper right-hand corner, the recycling logo. I know that growing up in California, my access to recycling has definitely changed over the years. We used to just have trash cans that we drug out to the curb on Thursday mornings. Eventually, the trash cans were complemented with a recycling bin. We started with just a specific recycling bin, and then that has even gone on to be more specific, where you have green waste, solid waste, or trash, the trash can, and then a recycling can. So we have more ways that we can actually make an impact. Another thing about reusing and being sustainable, who here has brought their own bags to the grocery store in the past year? You may have been doing this because you felt like it's the right thing to do. And on the other hand, there is legislation around this where there's a tax, there's a fee to purchase your bag in the grocery store. So we're being encouraged by leaders in our community to be sustainable, to recycle. So it's interesting that we are able to change our habits and the way that we live and what's normal, whether we're choosing to do so, whether it's the technology that we're faced with, or whether it's simply through legislation. But we are engaging and living differently than we did 5, 10, and especially 15 years ago.
And it's been my experience. We uncover our clients' values, and of course they're represented across all these spaces. The question was more, how do we represent that through direct investment versus, their activities. So as I said, this kind of word salad, and we hear it all the time in our businesses, how many different ways we talk about this kind of investing and different segments of that investing, but I've come to just call it responsible investing as the overall umbrella term, and I think Nuveen engages in that same way. So maybe you could speak to that as, what are all these different pieces of it?
Sure, Paul, and absolutely, it could be alphabet soup in some cases, or a word salad. I don't know what's for lunch today, salad or soup, but exactly. There's a lot of different terminology that's out there. Some has come to market before others, but what you'll see on the screen are a lot of different ways that you can refer to values-based investing, whether it's SRI, sustainable finance, ethical investing, sustainability, impact investing, microfinance. I always think of that one. I just recall when you go to Starbucks, sometimes there's like a water bottle that you can buy and it provides microloans to women that need some help there. So it's interesting. There's different ways that you can vote with your dollars and invest in this way, but the overarching terminology that encompasses all of this is responsible investing. So it's not going to be necessarily faith-based, but the goal of this type of investing is really to enhance your long-term performance by managing risks that we traditionally were not measuring. And at the end of the day, you get the benefit of it also being aligned with values. But I wanted to emphasize that the reason why we're doing this is not just because it feels good, but we're finding out that you can actually have outperformance when you look at risks in a different way. And we'll talk about what some of these risks are that you're not finding on balance sheets.
And this is, it's been the kind of debate over the years is, are we impacting performance? So certain clients would have specific needs. We would go seek out those investments that would represent that. But certainly the data has come in over the past, decade. We can't see any impact to performance, and then I'm sure we'll talk about some of that risk control, which ends up really going to performance, that it might actually enhance some of that. So that's where we've come to the conclusion that there's no reason to not implement this across all our platforms, all our investment styles, where appropriate, and not have to wait for our client to ask for it. It's in various aspects of investing, we look at different factors, right? Price earnings ratios and book to value and all these kind of measurements. And I'm thinking that, within the next decade, if not sooner, we'll have this just as another factor to consider. So, so we're starting to put it in everywhere. So talk about the ESG is the other kind of terminology that's thrown out there, these different factors, and how does Nuveen look at it in terms of implementation?
Sure. And so one of the alphabet soups that was on the other page was ESG. So what does this stand for? This is one of the more modern ways to look at responsible investing. ESG, it stands for environmental, so your environmental impact, the social responsibility of a company, and the corporate governance. So that's where the E, S, and G come into play. And so when you think about ESG criteria of a company or how they are expressing themselves in these different ways, it's oftentimes in intangibles that aren't, again, found on the balance sheet. They're not in these traditional ways that we're measuring the value of a company. But that being said, we're finding that they are imperative to have strong ESG criteria to provide outperformance versus your peers. So we look at what type of company can perhaps have a catastrophic event or a risk that's related to these three different pillars, I guess you could call them here. And so I want to give some examples on connecting the dots on why does it matter if you're environmentally friendly? Well, okay, so it does feel nice to be efficient with resources, right? I grew up in California. We're very water conscientious, especially because we're a drought-prone state. Some part of our state is that we have a lot of agriculture here. Our parent company, so I work for a company called Nuveen, and we are part of a company called TIAA. TIAA is one of the largest landowners of vineyards in Napa, which is here in California. And so growing grapes is actually very water intensive in this environment. And so we, as being landowners, have a vested interest in making our land look attractive to people to lease it. So what did we do? We ended up working with the Department of Sanitation in Napa to reroute wastewater to irrigate these crops. And so what we ended up doing was we were able to reduce the groundwater usage by 75% by recycling water. So we were reducing our usage of a natural resource, but we were also in turn reducing the cost of our irrigation by 65%. And so this cost reduction, it's a win for the landowner, it's a win for the grape grower, and sometimes I like to think it's a win maybe for the wine drinker. Maybe it's $1 or $2 less a bottle if I can get these grapes water cheaper. So that's why environmental considerations are important for a company or that's doing something. So it's actually, just think of it as resource management, doing better with what you have versus your peers, competitive edge. On the social side, sometimes we think about this as, oh, it's just treating people nicely, diversity, this is fluffy. What does it really mean for a bottom line of a company? Employee relations is huge. Talking about these intangible assets or intangibles around a company, employee satisfaction is a gigantic component to many companies' well-being and business continuity. Think about this. So we overnight here in the US, essentially overnight, they maybe gave us a few days notice. Everyone's got to work from home. No more office buildings. We're going to go shelter in place for the next 2 weeks, which turned into 2 months, which turned into two quarters. But anyway, we were caught by surprise that we had to adapt to this work from home situation. Companies who had high employee satisfaction, who were already allowing their employees to work from home, to have flexible work schedules, great health care, perhaps elder care, child care, with all these things in place that were just thought to be maybe a nice to have or just very forward thinking, became essential for a company's business continuity overnight. And so we saw companies that were doing this already when they weren't forced to be able to basically run a circle around the competition while transitioning from work from home. So better supply chain management, better business continuity, and this all ties back into health and safety and all of that. So the social has been incredibly important this year, especially.
And Margaret, I can talk about the health and safety. LPL has its own responsible investing. They call it sustainable, but a study group, if you will, meets pretty much every other month, and I'm participating in that. This morning they had their latest session and talked about the COVID response and how an organization put out a 5-point safety plan that got a lot of signatories on it, very rapidly. But not every company did that. And so those are the kind of companies, again, managing risk in a different way. Doesn't go, directly to the bottom line, but eventually those kind of risks can catch up to you if you don't manage them well.
Oh, absolutely. It might not be directly tied to the bottom line at first glance, but you could tie it into all these things. Again, just employee satisfaction, if you wanted to quantify that, the uncertainty from working from home, the work-life balance, catering to that or ensuring that there's some sort of plan, ambiguity in these types of environments is incredibly stressful. Stress is linked to so many diseases. It's incredibly important to have that in place, and it helps with your company's reputation also. So yeah, absolutely. That's great to hear that you guys have that.
Yeah.
I'll move to governance right now. The final pillar here. This is one of the least polarizing. Sometimes you can say that the first two could be tied to politics. Corporate governance is the least political. It's apolitical, if you will. The way that I like to summarize corporate governance is if you are owning a company and that company's CEO ends up on the cover of the New York Times for the wrong reason, because it's an ethical issue, because there's a shady compensation issue, it's really bad for your share price. You don't want to open up the New York Times and see that. We like well-run companies, companies that are run ethically, that have shareholder value in mind. You want a separation of the board and the C-suite, things like that that we look for. Diversity of the board, that's not just a nice to have. The more different backgrounds that you have contributing to solve a problem, looking for a solution or looking for growth, if everyone grew up on the same street and went to the same school and had the same hobbies, they've probably encountered the same problems and came up with the same solutions. But if you diversify that out and people grew up on different streets or different countries, speak different languages, have faced different challenges, they've encountered, again, different challenges, and then can throw some suggestions into the hat that give us more to choose from. So it's just more information to make better decisions off of. That's board diversity, and I think that resonates and rings true just for ESG criteria. More information for us to make better decisions off of. So with ESG, oh, go ahead, Paul.
Yeah, well, I think this is where, you know, again, whatever we want to call it, these ESG factors, but what we've come to realize is that putting it into a portfolio, again, is just an overlay to what we're currently doing. It doesn't take away from anything. It just adds another layer of protection, if you will.
Absolutely. Yeah, I'll repeat it again, more information to make better decisions off of. So how do you integrate it? Where does it get integrated? It can be all along the investment process, whether you're looking at an individual company. So you could look stock by stock to see how they're doing. You could look at your whole portfolio as it's been put together to see how everything's working together, what the ESG score is, what your carbon intensity of your overall portfolio is. And then also it's great because it's not just limited to stocks. You could do it in your bonds. You could do it in alternative investments like real assets, like that farmland I was talking about. So it's something that you can look at from a lot of different lenses, however you want to integrate it, by the piece or by the whole. But we have so much great information these days and research that's being done around it that it's not limited at all.
Well, you know, 30 years ago was a few niche players and a few fund companies, and now it's, you know, in exchange traded funds, mutual funds, you name it. Companies like Morningstar who monitor this have their own scores for it. So yeah, it's a lot more available, and it was pretty much just stock funds back then, and now it is across the fixed income space as well.
That's right. And so what you're talking about, kind of the olden days, how far back we want to call this prior time, let's call it the early 90s. That's when a lot of these investable strategies first came to market. They came out as mutual funds, and they were typically very exclusionary, meaning they would just take a look at this investable universe and say, hey, this feels wrong. I don't think that this is right for us to invest in. So let's get out of energy, out of defense, maybe a couple other things, cigarettes, alcohol, tobacco, whatever, something like that, gambling. Let's take them all out. And that makes sense if you're just doing this emotionally. But what we were finding is that there wasn't a real investment rationale behind taking a large swath of the market out of your portfolio. And so evolving out of this exclusionary process, this exclusionary methodology, again, now that we have more information, we could say specifically within energy, what is the risk? Specifically within firearms, what is the risk? I'll just briefly talk about where we would exclude something from our company's perspective is we call it controversial business involvement. And typically what you'll see in these types of businesses that we don't want to invest in is their product can cause death, bodily harm. And so if your product kills people, you have a catastrophic event from that, just to be blunt, it's bad for your share price if you have a bad thing happen. So that's where we will take an exclusionary approach. But in general, and this is more of the modern way of doing the responsible investing, is that we include the highest scoring companies for their ESG scores. So we want to reward the companies that are doing better. We want to just seek them out and put them in our portfolio. So we choose top ranked companies by their ESG score. That's one way to do it. You can invest specifically along themes, women on boards, clean energy, low carbon, microfinance, things like that. So you can do a thematic approach. You can do approaches that are quantifiable about your impact. Are you aligning with goals that end poverty, protect our planet, are ensuring the prosperity of the human race? These types of goals have actually been outlined by the UN. They're called UN Sustainable Development Goals, SDG. There's 16 of them, and one of them that's quite popular right now is vaccines, and healthcare is one of them. And so it's really interesting. This is all tying together this year. There's COVID relief bonds that you can invest in, and there's a lot of money going towards that's investable.
Yes, I think you really talked about that evolution. And this is, again, coming back to more concrete terms, is looking at how to make better decisions and better portfolios. And I find most investors want to incorporate these. They just may not know they existed.
Right. Yeah, this slide is really just an echo of what I was saying, that 84% of the market value, so if we look at the S&P 500, we just call that the market, the majority of the value of these companies are in the intangible assets. It's in the employee satisfaction. It's in your brand's reputation. What are you doing? Are you speaking out against injustices? Are you taking a stance on sustainability? Things like that. They're important to people, especially when you look at one company that's doing the same thing and compare it to another. You're going to want to compare it, especially if one comes out with a stance. So it's looking at important parts of a company that we traditionally just didn't look at and measure. It's looking at risks that exist today that didn't in the past, which we're all very familiar with. More and more risks every day. And there's a great opportunity for investment. We don't have to seek out little niche programs. I mean, the COVID relief bonds, we, for one of our fixed income products, wanted to get into that. I think that they only issued like 3.8 million in this particular one, and it was subscribed to 380 million. There was 10 times the amount of demand than the actual bonds that were available for purchase. So there's a very large opportunity to participate. It's not a niche.
And this idea, this opportunity here, the 12 trillion, and you had mentioned it before, but these UN Sustainable Development Goals, to me, drove a lot of the Fortune 500, if not, other companies as well, to have some criteria to shoot for, right? And entities like Morningstar and other firms that analyze started looking at whether companies were reaching towards those or not. So I think that was a major driver for a lot of what we've seen.
Absolutely. Some standardized framework, goals to shoot for, things that are being supported. It's mainstream, definitely.
So you got a couple examples here.
Yeah, so a couple examples. I'll just give stock stories quickly. We're coming up to the top of the hour, but this is an ESG rated company that's a CCC. That's not a good score. That's pretty much the lowest score. It's something that we actually don't include in our portfolios. It would be non-investable from an ESG score standpoint. And if you look at the chart, basically you're in a downward slope. This is not something that we want to be holding, right? So you don't need to know all the technicals behind this, but generally, directionally, this isn't the ride that you want to be on. This is a company that was involved, it's a hospitality company, and I know that they have all been hit within this year, but specifically the reason why this one is rated low is because they were found to be intentionally polluting the ocean. They were fined about $40 million because of this and took a dip. Actually, this year as well, they found to be intentionally in breach of their probation and got another $20 million fine. So even worse for your share price. It's making a bad situation worse. So having issues around their toxic waste emissions and their carbon emissions and some of their labor practices. We already identified that they were a weaker company, and you see the slow and steady decline, and then it fell off a cliff this year.
I actually saw the CEO of this company, which will go unnamed, on one of the financial shows yesterday, trying to talk about their pent-up demand and how this company is going to come back. But they've got a lot of work to do.
Yeah. On the other hand, this is a stock that you would want to be on for the ride, generally sloping upwards. This is a software company, so they don't have hard products. Their stuff doesn't go on a truck and get shipped across the US to your home and mine. This is all up in the cloud. You can download it. And if you think about a company that's running like that, what is the meat of this company? It's the intellectual capital. It's the type of employees that they have. And so it's really important for a software company to have really strong employee development, to keep them satisfied and happy and within their own company, so they don't leave and go to the competitor. So this company actually was awarded or noted for having a really great acquisition strategy. So as they were acquiring other companies up in the San Francisco Bay Area, they did a really good job on keeping the employees happy and keeping them intact, because that really is the value in these. Another point on this chart that I'd like to point out is towards the far right, 2020 here. We have the first quarter, rising tide raises all ships, lifts all ships. The same happens when you have a pandemic, all ships sink a little bit. But what we found with this company, because they had so many strengths in their ESG, their recovery happened quite quickly. So you do see the drop off in Q1 of 2020. And if we were to smooth out a little bit of these jagged returns here, you basically are getting what we call a V-shaped recovery. They dipped down and they rebounded from the bottom relatively quickly. They've almost recovered to their peak from the beginning of the year. So a strong ESG company here.
And that wasn't just this company. This is where we really saw the relative performance through the first half of this year, was that bounce back for ESG criteria companies. The higher ranked companies had less risk. I mean, it was clear. So, speak to these ratings. Who makes the ratings?
Sure. We use a company called MSCI. And MSCI is a leader in the space. They have over 200 dedicated professionals who are doing the research. So the first thing is they look at each sector and say, what's important for this sector? Software company, am I going to look at your environmental impact? Am I going to look at your E-score, scrutinize it? Probably not. We're not in the Amazon. We're not cutting down trees. We want to know, how are you treating employees? What are your carbon emissions like? What is your data and security around people's data, your own data, things like that. Privacy and data security is important for a company like that. So MSCI determines what's important for each type of company, and then they go and rate them versus their peers. So it's called Key Performance Indicators, KPI. It's different for different types of companies, but they're the ones that are taking a look at it. And again, over 200 people globally who are doing this research are looking beyond the material public information that gets pushed out there to shareholders and to the general public. They're looking deeper, and that's the research that goes behind this. Performance. We've got a couple slides on performance and I'll wrap up. But absolutely, like Paul said, this year and in the past recent years, ESG has been a great risk mitigator and helping companies outperform because they're like losing less. If you take a look back into the early 90s when this chart starts, everyone's really on top of each other. And at the very least, that would be the message to take away. At the very least, integrating responsible investing does no harm. It's not going to cost you anything. It will at least give you very similar patterns of performance to the market, which we're showing here in the S&P 500 or the Russell 3000. That's what we're looking against with the responsible investing benchmark. Now, it did no harm. In the past 3 years, we've actually seen it take off. This is due to more investable strategy, better information around what makes a key performance indicator, and better research and gathering the information around what these companies are doing there. So depending on how you implement these ESG criteria into a research methodology, it's really, really helped outperform. And again, this year, it's been really, really important.
Well, I would guess that there's some cost differentiators there too. As I said, in the early days, we had these, relatively small firms, which are going to have a higher cost of management, and the information flow is much better. So when larger firms like a Nuveen and virtually every fund company now has some sort of ESG strategies or responsible investing strategies, I think that cost has come down as well.
Yeah, it's kind of like a big data effect. So what we've gone through today, do you have an ESG mindset? Maybe you haven't labeled yourself as such, but we find that most people, when asked, would you like to know if there's a risk of polluting an oil spill or other sort of disaster? Would you like to avoid that if there was an indicator that this could happen with a company? 89% of respondents said yes. That goes with the E score. 84% of investors said if they could know that a company was having issues with human rights abuse, that they probably would not want to invest in it. Well, there's the S, not found on a financial statement, right? And then finally, the governance. This is where we can all come together and agree. We want to be invested in companies that are not in the news for harassment cases, for fraud, for scandal, for tax evasion. 91%, most people would say, yeah, if I could know that about a company, I'd like to integrate that information into my selection process. So whether or not you label yourself as an ESG investor, if you take a look at what ESG investing means, there's a high chance that this is something that is something you'd want to consider.
I think that's it really, is that I've taken the stance that virtually no client's going to object to adding these criteria in. So when we're implementing them on behalf of our clients, I think it's for all that performance, risk, and aligning values. So
okay,
Shannon,
we're moving into the Q&A session. Let me remind participants to email questions to me. My email's on the slide. And a couple questions have actually come up. First is, what % of a portfolio makes sense to have allocated to ESG?
So really that overlay there isn't a percentage. It can be 100% of the portfolio. The difficulty would be finding, some funds that would represent ESG, let's say in emerging markets or some bond area that we haven't considered. But Margaret, at this point, is there any sectors that maybe don't have an ESG fund available? Do you see any of those?
Where we get requests that we don't have, and I don't know if it's been built out broadly in the universe, is that there's like sector specific. If you want a ESG commodities, ESG healthcare, as far as size and style, you can get everything. You could get large, mid, small, growth and value, the emerging markets, international, corporate high yield bonds, and then the thematics, we can go all crazy down that rabbit hole of really nuanced specific places that are important to investors. So the space has actually grown, safe to say exponentially. It's gone from a handful of investments to hundreds in the past few years. And so it's absolutely feasible to get a complete asset allocation. You can shop around. I would say something to consider is who you're purchasing this from. Is it a company that's just popped up and they said, here, we're going to give it a go and attempt to create a strong ESG portfolio? or do they have a heritage and a background in knowing where to draw the line and what's important for performance?
Yeah, there are some that are driven more by the marketing department than the investment department, but I think it, pretty much covers most of the portfolio.
Okay, great. Another one is ESG related to politics?
That's a really good question. From our responsible investment team at Nuveen, we say it's apolitical. We're saying this is a risk mitigator. Now, there are some tailwinds that could be created from, let's say, a Biden administration. We do know that there's policies that would be potentially put in place that would incentivize incentivize companies that operate with lower carbon intensity. Another one actually that I was surprised to see with the Biden administration is pay equity, things like that. So while it's not a political statement, sometimes we can have tailwinds from political administrations. And it seems to be that this could be where the puck is going, and it might make sense to skate that way.
Okay. Given the presentation, I think we already touched on this one. Given the presentation, can you tend to move someone's portfolio to all of these kinds of funds if given the client's interest level?
Yeah, and we can tailor it. We have our strategies where we're employing them directly. But some clients have specific requests, and Margaret hit on one. There's a women's equity fund, or specific strategies. There are things like if you want to avoid defense, we can do, tailor it to a specific need. But yeah, it's definitely available.
Okay, and we'll just take one more and then we'll have to respond afterwards. This one is, so costs have come down. How do they compare to other funds?
I'll let you take that, Margaret.
Sure. There's a couple, when we say funds, there's a couple different types of funds that you could talk about. How can I answer this?
But essentially, is there an added cost to it?
There can be, yeah, the simple answer is yes, there's an added cost because of this research. These 200 people at MSCI don't work for free. That being said, so the cost of these ETFs, the ones that I've been moving around today, this conversation has essentially been around, they range from 20 basis points, so that's 0.2% as an annual operating expense, to 45 for something that's very harder to access, like an emerging market fund. And so it just depends on what you're comparing it to. For a mutual fund, sometimes we say the average cost of a mutual fund is 1%. So we have to take a look at apples to apples, oranges, sometimes oranges to apples, but there are low cost vehicles that you can access responsible investing from that might actually even be less expensive than something that you were invested in, depending on what type of investment that was.
Well, this gets back to the, active funds versus passive funds, index funds, what are we buying and what's the cost? It's a complex kind of conversation around that. So there might be an added cost, but like you said, relative to what? You just need to really look at the cost of any investment that you're doing. And, we do that in our screening process. It's not the only criteria, but it's one of them.
And one thing that I would add to that too is what is the benefit that you're getting out of this cost, right? So do we spend a little bit extra more money at the grocery store? Do you on occasion go to Whole Foods or buy particular things that are organic or biodynamic or something like that? Do you nurture your body in ways because there's a long-term cost savings where it's like, maybe I won't get this disease, or maybe my body will be in better shape, so it's going to cost me less in the future? It's actually very similar to responsible investing. You can pay a little bit more for a higher quality investment now to get excess returns. So even though you pay more, you get, if you're getting more than just investing in something that's very, very cheap and you get the returns out of it, then what is the cost? What is the true cost of investing? So it actually, think about it, you can think about it that way as well.
So wasn't it Nuveen's phrase, it's not what you earn, it's what you keep?
That's true. Yes. Yeah.
Well, it's not what it costs you, it's what you make, right?
Right.
So that, you know, that net performance is what you were showing, the outperformance net of all costs, so.
Oh, looks like we lost Margaret. Well, we're wrapping up anyway. I'll have to follow up with the couple questions that we still had come in at the end, but thank you everyone for participating. Thank you, Paul and Margaret, for bringing this valuable information to us all. And we wish you all a safe and healthy day and a warm and wonderful Thanksgiving. Thank you.
Thank you, Margaret.
Thank you. I just lost connection briefly.